Hello, everyone. Joe Mass here. Hey, I just want to talk about some of our synergy snips and what we're thinking about over the weekend. Just share some thoughts with you as we were doing research this weekend. Okay, so let's talk about to hedge or not to hedge. So what we're talking about here is I wanted to show you this chart. This chart shows the demand for hedges. The math is kind of complicated. It's called the skew watch. I don't really want to get into what that is. I just want to show you that there's not a lot of demand out there to hedge, which you would find interesting, right? Because the market's down 18% for the year. We think that this volatility, even though, and we'll talk more about that in a couple slides, has been high with the market down, the causes are well known, right? We know why the market's down. It's not a surprise. Tighter monetary policy, surging inflation, supply chains, geopolitical pressures, right? All the usual suspects that we've been talking about over the last year. It really doesn't surprise me when I think about it and look at the data that the demand to hedge is not there. There's a little panic in the institutional investors, at least. Again, the individual investor still has to worry about should I fight risk or should I fight inflation? And we'll look at some more evidence of how the top wealthy 1% are allocating their assets in just a minute. But, I think the main question here is just, will this change? Are we going to see this jump? And so we're paying attention to this. If this index starts to really rise, we'll start to think that the market's starting to panic. So anyway, just kind of interesting. I would have thought this would have been a little higher, but again, when you think about it, my hypothesis is that everything's in front of us right now. We know what's going on, and so people can kind of plan accordingly for that. So on the next slide, what we're looking at on the top chart are the credit default swaps. So that index, and that has been going up. So the spreads on the credit default swaps have been increasing, and so that's that would be expected. On the brink of a recession and all the things that we have going on. But the bottom chart, which is kind of interesting, is the VIX, which we've talked a lot about the VIX before, the volatility index, the fear index, and it's been kind of trading sideways. And if you'll notice on the chart that before the S&P usually bottoms out, it typically rises to that 45 level, and so it may not reach that level and we may get a soft landing, or B, it hasn't happened yet. So we're going to pay attention to that. Now, one thing that we can talk about with the VIX is we can look at the VIX of the VIX. So we can look at the volatility index of the volatility index, right? So it's the second derivative. And we'll notice here that it's below 100. And it's been coming down. So the VIX has been trading flat, and the VIX of the VIX, or the volatility of the volatility, has been coming down. And so that might be encouraging. We'll have to wait and see. Now here what we're looking at is the top 1% U.S. household as measured by income. And what you'll notice on the left-hand chart of the graph, the top 1%, that they're holding a lot of blue, right? That's a lot of equities. Even though the markets have come down, they're still holding a disproportionate amount of equities in their portfolios. If you look at the right hand of the chart, among the bottom 1/5 of the households, their wealth is in real estate, and not surprisingly, because this is where your home or a rental makes up a lot larger portion of your balance sheet than your equities. And so that, we can see that orange bucket there, the real estate bucket, is really high. And so that could be concerning if the housing market falters, right? We have interest rates going up. We think they'll still continue to go up. Housing's coming down. We've been neutral on it because we should be having a positive effect to the investment properties out there with a raising rates or raising inflation, but we have raising rates right now at the same time, right? So for investment properties, if we can raise the rents, they become more valuable. For the consumer, who now can afford 30% less house and their payment's gone up maybe 40%, that's not a good scenario. So we've got a watchful eye on that, but I thought this was just kind of an interesting piece of data. We're going to stay our course. We're managing each portfolio per its design. We're suggesting to be diversified via broad asset allocation and multiple strategies. So we're kind of hedged, right? We've been talking about inflation and risk for quite some time. And we're just going to watch the data and try to recalibrate as best possible. So as this research is done each week, we'll make some adjustments to the portfolios. So what you need to do is please let us know if your risk or return objectives have changed, right? So we can adjust the portfolio strategies for you or discuss the pros and cons of how your portfolio might react with the different scenarios out there. And then second, please let us know if your portfolio constraints such as your time horizon has changed, right? If we're a long-term investor and now you're really worried and you're now a short-term investor, we need to adjust the portfolio. Or if you were a short-term investor and you now are a long-term investor, we need to readjust the portfolios. If your liquidity had changed, right? If you need a lot of money coming up for something, a new roof, a new car, a college, a wedding, whatever it might be, let us know. We might need to adjust the portfolios. Or if you've been sitting on a lot of cash and you're like, maybe it's time to start, dollar cost averaging back into the market, again, let us know about that. And then of course, always let us know if your tax preferences change, and we can then talk about the options that we have and the strategies that we have to not only minimize taxes from doing forward-looking tax planning, but also from recalibrating and adjusting the portfolios. So those are some thoughts for you. Okay, so those are the things that we're going to do, and those are the things you should be doing. And I guess last thought for the day here is, we're talking about a soft landing versus a hard landing, right? So we got our heads, maybe that's a soft landing. Tails, oops, I got heads and both heads. That's a mistake in my slide there. One should be heads, soft landing. One should be tails, hard landing. Apologies. But if we're looking at the left-hand side of the screen here, at the soft landing, there is new data. Commodity prices have been coming down, which has pushed interest rates down here over the last couple of weeks. We have a wider supply chain, right? It's fighting inflation. There's some positives here. We also have labor and housing markets have cooled as the Fed has raised rates. This is the effect that the Fed wanted. They were hoping as they raised rates, we would start to see the economy softening. We would start to see inflation coming down and starting to have some deflation. There is a scenario out there that we can have a soft landing. On the other side of the coin, the hard landing. I think there's really a lot of pundits are talking about potentially two paths, probably more, but at least two paths for a hard landing. One is that inflation kills the economy, or the recession kills the economy. And so that's kind of your hard landing scenario as well. It is nice that there's always two sides of the coin, and it is nice that we have been getting some data over the last couple of weeks that is suggesting some positives for the soft landing. And I think there's probably a lot more scenarios and uncertainty or paths that could play out with a soft landing, whereas on the hard landing, it's probably really inflation kills the economy or the recession kills the economy. So as always, these are our opinions, right? We don't know what's going to happen in the future. Our crystal ball broke, but we'll still try to do our best. So please read the disclosures and realize that these are our opinions and not statements of fact. So with that, we'd like to thank you for taking the time to listen to our little update. Again, if you have any questions or concerns, reach out to us. Thank you so much for your trust and confidence. We really appreciate it, and we appreciate you. And have a great week. Thank you, everybody. Bye-bye.